Another key element is looking at the valuation of the company. And in this piece, I want to talk a little bit about the types of valuations that you can do of companies. So they can be asset based, market based, earnings based, cash flow based. So there's a variety of different methods. And again, part of this depends upon the type of information you can use. So asset based can look at the book value, or you can make some modifications of that book value and really looking at the assets, adjust it for the differences between the book value and the current market value, and taking out the things that maybe shouldn't be in there. So it sets a floor price, at least in terms of this is what the assets are worth of the company. You can use it in terms of the replacement value of the assets, or you can also look at the liquidation value of the assets. And again, same sort of type of rules as book value, and what you're doing is looking at in terms of what's this company worth based on the method we're using, or you can do, if you have time, do it in terms of the comparison and then give your audience an idea in terms of, this is the one we think it should be. Market-based is based on price earnings ratios of comparative firms. It's based on after-tax net incomes. Generally, it's public. It's easy. If it's a private, it's hard to do because it's hard to find comparators. Earnings-based is a value based on the organization's earnings, normalized earnings divided by the capitalization rate. Sort of what are the normal earnings? And again, you have to watch in terms of getting rid of the things that shouldn't be included in terms of those earnings. What does the earnings, in terms of if someone else has this company in their hands, what would they look like? And the capitalization rate reflects the riskiness of the business, and they vary depending upon what you're doing in terms of the business. 15% for a small, stable business, and maybe 50% where assets walk out the door every night, and sort of thinking about those types of pieces. Cash flow based is the Pierce method. From a corporate finance perspective, it values the business based on the cash generating, or the cash it's generating. It's a forecast of the future cash flows discounted back to today. And the big problem here is the predictability of the cash flows is often an issue. And you have to think about the discount rate that you're using and what's the risk premium involved. And again, a chart here in terms of an established business, that risk premium is maybe 6 to 10%. Established business in a more competitive environment, 11 to 15. A business in a very competitive environment, 16 to 20. A small business, a highly cyclical business, maybe 21 to 25%. And as you look here, it gives you some descriptions in terms of what those types of businesses look like, but it gives you a rough estimate that you can use in terms of a discount rate as you're going through and starting to calculate these items. Other methods you can look at are there's some rules of thumb for quick valuations for some types of firms. Private SEMs may be 3 to 5 times EBITDA, or 1.5 to 3 times cash flow. Accounting firms, 100 to 150% of annual revenue. Bookstores, 15% of annual sales plus inventory. Law practice, somewhere between 40 and 100% of annual fees. So again, just some rules of thumb in terms of giving us a bit of an idea of what is this company actually worth. There's a lot of issues here that you have to consider. And so in an owner-managed business, the my baby premium is there. You have to convince the owner that, it's not as worth as much as they think. And there's non-quantitative considerations like industry attractiveness, potential for or actual legal or environmental issues and the possible impact of those, things like union contracts that are existing or pending, strategic alliances in the supply chain or the distribution channels that may change if someone else takes it over, or things like location. Is the company you're looking at not in a superior location versus the competition? So those types of things as you're going through, and this list can go on and on and on.